Joshua Stirling captures the top spot in the insurance non-life sector in only his second year on the All-America research team. The Sanford C. Bernstein and Company analyst explains why the industry's boom and bust cycles are a thing of the past and why the future prospects for insurers look quite promising.
The insurance industry is healthy these days because they've proven that the boom and bust cycles of the old insurance industry are a thing of the past. What we've seen over the past 3 years is that the companies have raised pricing by about 20%, not because there was a supply destruction, and not because there were capacity constraints, and not because there were lots of insolvencies and pain throughout the sector, which is the way it had always been in the past. But rather, what happened was that interest rates fell, the industry caught an inflection, and relatively real time figured out that loss trends were accelerating and started to raise price. And what's different today is that data technology and much better industry discipline at the largest players has led to an industry which, is sort of much more utility-like, much less boom and bust, and ultimately going to be much more investable in the future. Among the broader insurance industry, the most structurally challenged names are in the reinsurance group. What's happened is that the alternative asset management community, hedge funds, as well as sort of classic investment managers like pension funds, have all gotten into, for various different reasons, wanting to participate in securitized insurance risk. This is coming in and creating a dramatic increase in capacity, sort of capital, chasing a very sort of finite pool of reinsurance dollars. This is leading to price cutting. This is leading to margin compression. The stocks, fundamental analysts all agree that these are major challenges, but earnings estimates are still high, and the stocks have yet to underperform. And so we look at this group and think fundamentally, it is likely to get much worse before it gets better. And ultimately, we think the stocks for reinsurers, folks in Bermuda, Lloyd's of London, the continental reinsurers, these are much more likely to be sort of challenges for investors rather than opportunities in 2015. We like the commercial lines group as, there's commercial lines, personal lines, and reinsurance. We like the commercial lines group as sort of a defensive ballast in this environment. The high-quality companies like Chubb and Travelers, for example, have a lot of earnings visibility. They buy back stock. They're very disciplined firms. But as P&C pricing, as commercial P&C pricing slows, it's more likely the multiples contract than expand. And so we think the stocks, broadly are useful in a portfolio as more ballast like names against a bunch of other higher beta things, but ultimately not that exciting. What is exciting is the personal lines group. Progressive in particular is at the very dawn of introducing a new technology called telematics. They have a product called Snapshot. We think over the next 12 to 18 months, they're going to drive a substantial amount of growth because what they're doing is monitoring drivers' actual driving behavior and materially reducing prices for the folks who never drive or who are very good drivers. And of course, what this does is steal all the good drivers from other companies, gives them a big disruptive competitive edge, and ultimately we think creates a very sort of dynamic and interesting sort of both technology story, but also just sort of classic underwriting-driven opportunity for them to grow and take margins from peers. And so, we're sort of looking for that to be the most exciting part of the 2015 story.